Adobe stock is too cheap to ignore, and in today's video I'm going to tell you the reasons why. We'll look at why Adobe's stock price keeps falling, Adobe's business model, their competitive advantages, the risks the company faces, and finally Adobe's valuation. Over the past 5 years, Adobe's stock price is down over 25%, which is awful performance compared to the S&P 500 index, which is up roughly 80% during the same time period. But this could be where the opportunity lies. Adobe stock has underperformed mainly due to concerns around slowing growth and stronger competition in AI and design tools. Firstly, Adobe's Creative Cloud service, which includes products like Photoshop, Illustrator, and Premiere Pro, has seen revenue growth slow from around 13% to just above 10% annually. 10% top-line growth is better than most companies. However, at the time, Adobe's stock price was highly rated, meaning the valuation multiple was high. The combination of slowing growth and rising interest rates caused the market to re-rate the stock to a lower multiple. The stock went from trading at a 50 PE all the way down to a 20 PE ratio. Secondly, the market fears that Adobe's vast profits are being eaten away by competitors like Canva, Figma, and other AI-related design tools. Adobe even tried to buy Figma in 2023 for $20 billion, but was blocked by regulators, forcing Adobe to pay Figma, a company seen as one of its competitors, a $1 billion breakup fee, which provided Figma with a war chest of cash to compete with against Adobe. Now let's take a look at Adobe's business model to see why I think it's one of the highest quality businesses in the stock market. Adobe provides creative, document, and customer experience software for enterprise and individuals. The company benefits from high customer switching costs. Once a business or individual integrates Adobe's products into their workflow, it becomes very difficult to switch to a different provider. Adobe has created an ecosystem around its core products, bundling them together to provide more value to customers, entrenching them even deeper. Companies often have massive libraries of Adobe files, templates, and presets. Migrating these assets to new platforms is time-consuming and may cause loss of data or formatting errors. Adobe has high penetration in schools, which also enhances its switching costs as students learn to use Adobe products before they've even heard about a competitor's product. After you've spent years mastering your skills in Adobe's ecosystem, you aren't going to even consider leaving for a competitor. Adobe is a capital-light business, spending less than 2% of revenue on CapEx. Its remaining expenses, such as sales and marketing, research and development, and general and administrative, add up to roughly 60% of revenue, leaving a very healthy operating profit margin of 36%, which is up from 22% 10 years ago, showing Adobe's ability to cut costs and raise prices. Contrary to what you might see on social media, Adobe, despite raising prices at an average of 3 to 5% annually over the past 10 years, has not experienced increased customer churn due to its high switching costs and value proposition. Adobe is also a buyback machine. A buyback machine is a company that consistently reduces its shares outstanding using its free cash flow. Adobe has bought back 3% of its total shares outstanding annually over the past 5 years and a staggering 6% in the last 12 months, taking advantage of the sell-off in its stock price. Buying back shares has created a positive impact on the company's earnings because it divides them over a smaller share base. If we take a look at Adobe's free cash flow, we can see annual growth of 13% over the past 5 years. However, due to share buybacks on a free cash flow per share basis, they've grown closer to 16%. Now let's look at Adobe's competitive advantages. These are the factors that protect Adobe from losing profits to its competitors. We've already covered switching costs. Therefore, I'm going to focus on Adobe's ecosystem or distribution moat because I think it's relevant in relation to AI-related competition. Due to Adobe's large base of over 30 million users, including sticky enterprise customers, the company can distribute new features, including artificial intelligence, more effectively than competitors who don't have such a large and valuable client base. This makes their research and development spend a lot less risky because they don't have to worry about marketing new features as heavily as the competition. Adobe can integrate new features into its software, test them with a select group of customers, and if the feature is a success, roll it out to all of its other users. Smart investors focus on reducing risk. Therefore, we're going to take a look at the risks surrounding Adobe stock to get the full picture. The main risk surrounding Adobe stock today is the threat of AI disruption. Investors are worried that generative AI tools could erode Adobe's moat. Adobe has integrated its own AI features like Firefly into their ecosystem, but the market still fears it may lag behind faster moving startups. However, I'm less concerned about this risk than most investors due to what we discussed before about Adobe's distribution moat. At the end of the day, Adobe will win because not only can it develop great new AI-enabled features, but it can also distribute them to its existing user base. Due to Adobe's high penetration with enterprise customers, they've focused on making their AI commercially safe, training its AI models on Adobe-owned content to avoid copyright infringement. Now let's analyze Adobe's valuation. The stock currently trades at 15 times 2026 earnings, which on the surface looks insanely cheap. The free cash flow yield, even after accounting for the impact of stock-based compensation, is over 5%, which suggests the stock is lowly rated by investors right now. If we look at Adobe's historic valuation, you can see that the stock usually trades at a free cash flow yield between 2 and 4%. However, due to the factors I previously mentioned, the stock is currently trading at a 6 to 7% free cash flow yield. Based on my assumptions of Adobe's future, the fair value of Adobe stock is upwards of $545 per share. I recently sold my entire Adobe position at a loss of roughly 30%. My decision to sell was influenced by my desire to concentrate my portfolio into a smaller number of stocks. Adobe wasn't the only stock that I sold during this process. However, I'm now seriously considering buying back into Adobe stock because the AI narrative has made it too cheap to ignore, with Adobe's recent earnings indicating the company's competitive strength. That's it for this video. I hope you enjoyed. See you in the next one.